Hello and welcome to this video. In this video we are going to talk about financial model build, and first of all I would like to go into best practices before we put them into practice. For this video I planned the following. First of all, I would like to talk about some general practices for financial model build. Then I would like to go into practices for the data processing structure, so how the data is processed in the sheets or on the sheets and between the sheets. And then I would like to go into practices for clarity of presentation. First of all, I would like to point out that there are many different financial models. So if you look up in the internet, you will find many models there, mainly business models or DCF models, but there are many more. Let's go a little through some examples. So there are models for business analysis. So this is the very basic that we analyze financial statements in an Excel sheet and get some KPI indicators or whatsoever. Then there are business models or business planning models that are used to plan a few years ahead the financials of a company. And of course that is again the basis for DCF or discounted cash flow models for the valuation of a whole company. If you only do that for little projects like wind generators or solar parks or whatsoever, that will be a project finance model. There are also business models used in credit analysis, especially to find out if the company is able to cover the debt service. In option pricing, you will find many Excel sheets, especially for the valuation of often complex financial derivatives. So, in the typical bank practice, option pricing is implemented into the computers or into the computer systems of the bank, but if new and very complex instruments are made by the bank, they often start option pricing models in a spreadsheet in Excel. Of course, for the asset management, you will find portfolio models or portfolio optimization models. And on top of all that, you can use Monte Carlo simulations, so mathematical simulations to cover the risk of all the other models. So you can use Monte Carlo simulations in DCF, you can use Monte Carlo simulation in option pricing or whatsoever. If you use Monte Carlo simulation in project finance, you end up having a real option approach. So Monte Carlo simulation can be applied to all that. Well, these models, of course, differ largely in terms of complexity, in terms of data usage, and in terms of structure. So what we can't do is to have a one-fits-all approach. That won't work at all. But there are certain common rules that we can apply to all these models. So, what should a company do that uses financial models, especially if the company uses exhaustive or extensive models? First of all, the company should establish a modeling manual, sort of write down the rules how a model in the company is built. Standardize all the models. So that's the topic here. And of course, all the employees need to be trained to adhere to those standards. If done, a standard model should be established. A standard model is the basis for all new models, so that the modeling standards of the company are already implemented in there. So the most flexible type is, of course, a completely empty model where already the right formatting and some standards are preset. But normally in a company you will need many models of the same structure. So you can already set up some basis model, like for construction, project management or whatsoever, and modularize certain sheets so that you will have a sheet for the construction cost, a sheet for depreciation calculations, and so on and so forth. And later on, you can use those sheets as a module. So if you need 2 or 3 of them, you can copy them. If you don't need one of them, get rid of it and delete it. But you have those modules and you can put them together to achieve a new model. Of course, in a company, you will need to adhere to the dual control principle or 4 eyes principle. A model that is built by one person should be checked by another to assure the consistency with the modeling standards, and of course to check for the correctness of the calculations. And probably that model should be tested using test data too, just like any IT system is tested. And very important, the password protection. So as soon as you give a model to another person for daily usage, that person is not trained in financial modeling and might be a bit clumsy or untrained in using those models. Often these users destroy the models by changing the formulas. And that is very important because it ends up in erroneous formulas and you will never ever find those errors. So a typical example from practice is that a balance sheet doesn't balance and the user just adds +1 due to rounding errors somewhere in the formulas to get rid of rounding errors. You will never ever find this +1 again, but in the following years, no balance sheet ever will reconcile. So better password protect all formulas, and if the user wants to change something, he has to come to the modeler or to the modeling department and ask if he can do the change or not. Of course, it is important that these passwords are not only known by the modeler himself, but also by the head of modeling, because if the modeler leaves the company, a password protection might also protect any change ever. So these passwords must be stored somewhere in the safe or in the files of the modeling department. Well, there are top-down models and bottom-up models. Often enough, these models are not pure. Often you see mixtures between both. So what is a top-down model? A top-down model typically starts with very general data or general assumptions, and those assumptions will be broken down into let's say company business plans or whatsoever. So let's make an example. An apartment rental company could model economic growth. If the economy grows faster, the rental level will rise. Accordingly, the sales will rise. The cost will also rise, but then at the end, there's the income. So top down from economy to the income. Well, most business models are made top-down because there is no reason to go bottom-up. These models do not need exhaustive data, and often they're typically built in a horizontal layout, means that the columns are the years or the month or the quarters or whatsoever, so that you will have several years in a row. That means horizontal layout. The bottom-up models, they are different. Bottom-up models have exhaustive data in the background. So these apartment rental company will have some data storage, some database where they have all their apartments in and all the contract data and whatsoever. So they have the number and size of the apartments, the contracts, and they calculate something like a usually or average vacancy rate, and then they deduct the sales and the cost and the income. So from their own data. So this is a bottom-up model coming from an exhaustive collection of data, and this exhaustive collection of data is usually in a vertical form. So each contract underneath each other, or each apartment underneath each other, or whatsoever. So this is bottom-up coming from exhaustive data from the company going up. Where are those bottom-up models used? Typically in short-term cash models, where you exactly need to know if cash comes in or cash goes out. So where certain exactness must be applied. Well, let's go into the practices for the data processing structure. So the data processing steps go from left to right. What does that mean? Here's a little example. Here are the sales of a company modeled, and here we have volume growth and the volume, so how many pieces or how many items are sold. The company starts at 100,000 pieces or items, and that grows each year by 5%. So in the next year we will have 105,000, then we will have 110,250, then 150, 762, and so on and so forth. So this data goes from left to right, but never vice versa, never from right to left, always from left to right. Then the data is processed from the top of the sheet to the bottom of the sheet. So, of course, the volume and the price of those products need to be multiplied. So if you sell 105,000 at 1581, that will be sales of 1,660,050. So from top to the bottom. Again, never back, never from bottom to top. It might be in very, very few cases that you need deviations to this rule, like having a loop or something like that. But then you need to clearly indicate that you go the other way around. The same applies to the sheets. So if you see the sheets of an Excel here, you typically have a data flow or data processing steps from the first sheet here, model input, going via calculations to output. Of course, this is only an example. You can have much more complex models. Nevertheless, you start at the left and go then to the back of the model. But this is only true if the database is not too exhaustive. If you have exhaustive data, it would be curious to put it into one of the first data sheets. Of course, then you put it into the back, and then the whole model goes vice versa. So you start with like a bottom-up model, you start in the end and the data gets aggregated, and you have the output sheets in front. The next rule is one row, one formula. So if you have this row here, of course, this is always the same formula. Never ever even mind to put a different formula into this cell than into this cell. Even Excel will check that and will indicate that the formula is different in this cell. So one line, one cell. If you have a vertical structure where you need to pull down the cells, of course, then applies one column, one formula. So never change the formula in adjacent cells. Keep at least one cell apart if you want to calculate something else, or clearly indicate that it is a different formula. So, for example, if you have good reasons to have a different formula in this than in this cell, make a vertical line here, that it is more than obvious that this is something different, or leave a free cell in between. Typical financial models consist of several sheets, and it is extremely important that they are consistent concerning the columns, so that they have a uniform time axis. What does that mean? Let us have a look. Here we have column A, B, C, D, E, F, and the time axis starts with column G, H, I, J, and so on and so forth. So, on all sheets of the financial model, the initial balance sheet for the financial year 2019 should be in column G, and it should never switch the column. And the same is true for financial year 2020 in column H, and so on and so forth. It absolutely makes sense to keep the time axis a variable, so that the next year the model can be reused, having the financial year 2020 as an initial balance here. Of course, that can be done using the Excel date formula and having an input on the input sheet in front of the whole model, or in the preset section of the model. Of course, we can fix this axis, so if we scroll down, we can still see the whole time axis. Freeze panes is the button in Excel. So if we click here on this cell, sales, and freeze pane, we can move the whole lower part, or if we can click on this cell here and choose free panes, we can move the lower right part while all others are still be shown. For financial modeling, we can use so-called flags. Flags means that we use binary values like 1 or 0 to switch on certain parts or deactivate them again. And in formula, we can multiply with 1 or with 0. That is very important because it helps us to keep formula very simple, and sometimes we can even avoid if functions using this little trick. And of course, what we need are consistency and error checks. They can easily be used using if function and conditional formatting. Additionally, for input cells, we can use the data validation to restrict the values that can be inputted there. So for example, the values can be forced to be numeric, can be forced to be positive, can be forced to be between 0 and 100 or whatsoever. Some further considerations. We should always avoid circular references. Nevertheless, there are good reasons to have circular references from time to time, especially if we need iterations to solve certain mathematical problems. If we have that, we need to clearly indicate that this circular reference is intentional. And, of course, we need to keep the circle as small as possible. We should restrict it to one sheet, and we should never extend such a circular reference across several sheets. Of course, we should avoid nested if functions. So if we have a nested if function, we should disentangle these operations. And what is extremely important, avoid the linkage to other Excel workbooks, so to other Excel files, because they are always clumsy and erroneous. If you can't avoid that because you have, let's say, two different models, one planning model and another DCF model, and you need to exchange data between them, you should have in the one workbook, like in the business model, you should have an output section. And in the DCF model, in the other one, you should have an input section. And these two sections should be exactly mirror-like, so that it is crystal clear where the data comes from and where the data goes. For model audits, so for the second person in a company who checks all those models, it is extremely helpful to know that you can press F5 and go to special to quickly find many auditing functions that help you auditing the spreadsheet. Of course, you can use trace precedence and trace dependence to quickly understand the data processing, so where the data comes from and where the data goes. Meanwhile, there is software available doing some model audits, and there are also services whom you can pay to check the consistency. So the models will be typically sent to India and will be checked there. But of course, these people and those tools do not know at all what your calculations are about. They cannot check the calculations or the results of your model. They can just check the consistency. That's all. So if the model is properly built or not, but they will not understand what you're doing there. Practices for the clarity of presentations. Of course, it is extremely important that you orient yourself at the needs of the addressee of the model. So we need to have an addressee-oriented output. You need to summarize the complexity. A model is extremely complex, and typically a model will be presented to the management. The management does not want to understand the complexity of the model. They just want to see the key figures and the key statements. So make the output in a way that the management understands, a management dashboard. From practice, I know or I have seen that a financial modeler was fired. He has built a huge financial model and he built that beautifully. Nevertheless, what he gave to the management looked like crap. And the management lost all trust in this financial modeler, so they fired him because what they saw did not comply with quality expectations. So you will need certain outputs addressee oriented. Often those financial models have different addressees. So it absolutely makes sense to have different output sheets for different addressees. For example, like a management summary for the management and a backup for the controlling department. Of course, sometimes you will need tabular output and sometimes you will need graphical evaluations. Also, traffic lamp signs, so red, yellow, green signs or something like that will help the reader understand what you mean in your model. In any case, so whoever your addressee is, the output should have the key figures in, it should be self-explanatory, it should contain appropriate notes, so like currencies, dates or units or whatsoever, and explanations, so the interpretation of results or similar. As far as possible, they should also be formatted for presentation and printing in accordance with corporate design. And financial models are typically based on assumptions, so summarize these assumptions on an input sheet in the very front of your model. To structure your models, it absolutely makes sense to give it an outline with intended outline levels and headlines. So here we see that the sales are modeled, and okay, here could be another intended headline, and here we see a certain structure too. So we have very small columns here to make that indentation. Then, of course, keep the formulas and calculations as simple as possible and break them down into small steps, but never to the expense of clarity. So it must always be clear what you calculate here. We need to have a clear separations of input cells. Input cells are typically those orange ones here. Linked data cells that are not shown in this picture, but we will see them later on. Calculation cells that are those gray with orange font. And output cells that we see here, gray with black or dark gray font. Output cells are always the final result. Never some in-between results, but always the final result of a calculation that will be used elsewhere. So this obviously is a business planning model, and the sales, of course, will be used in the planned income statement. So this is the final result that will be used in the income statement. The other ones are only in-between results that we do not use elsewhere. Calculations, so formulas, you will find in those calculation cells and in those output cells, but nowhere else. There's no reason to put any formulas somewhere else. These are linked data cells. So these are linked data cells. This data comes from elsewhere, from another sheet. And it is good modeling practice first to gather all needed data on the top of the sheet and then to perform all the calculations. Or, in other words, no formula should have a link to another sheet. a formula that does the calculations, just like the cost of goods sold down here. So obviously here is a formula in. This formula only uses this data and this data, but is not linked to another sheet. Of course, the sales here the cost of goods sold are calculated based on the cost of goods sold intensity that is given here. It is simply hard-coded or inputted here, and the sales come from somewhere else, from a different sheet, so from the sheet sales. And it is copied here or linked data. But here in the final result, where the calculation is made, it is just 75% times the sales. Here is no linkage to the other sheet because it is made here. So that's good modeling practice. It keeps the formula easy to read and it keeps the calculation understandable. Keep in mind that your models will often not be read on the screen but on a printout. Especially management presentations are often made in PowerPoint or they will be printed out. And of course, the reader needs to understand those calculations even on the printout. And believe me, especially a management is absolutely not willing to go into the Excel and read your formula. Absolutely not. So it must be understandable what was calculated here. There are several ideas how to do that. You can use those mathematical formulas just like here. The cost of goods sold equals S, which is sales. It's given here that sales is S, times CI. It is given that cost of goods sold intensity, CI. And so you use mathematical formula to make understandable the calculations. Or you use those simple calculus, this times this equals this. Of course, this can only be used in very, very simple situations. In more complex situations, the mathematical formulas will be more practicable. Last but not least, of course, not everything needs to be visible. For internal comments, you can use the comment function and give a cell a comment. You can do that by pressing Shift and F2. That will open up a new command and you can comment anything you need for internal purposes, and that does not need to be shown on the printout. I hope that this video helped you. Thank you for listening and see you in the next video.